Hello everyone. Welcome to another episode of Wealth Insight podcast series, where wealth conversations come to life. And in today's episode, I'm joined by two extremely high-profile guests, Mr. Nilesh Shah, MD and CEO of Kotak Asset Management Company, and Saurabh Jain, Managing Director, Head of Affluent Segments and Wealth Solutions at Standard Chartered Bank. Thank you, Nilesh and Saurabh, for joining the podcast.
Thank you, Vinay, for having me here.
Thanks.
So Nilesh and Saurabh, wanted to start with the first question. We have seen a rising growth in affluence and wealth creation in India. If we look at the UHNI and HNI segments, net worth of about 1 million, we have seen that growth tremendously, and the forecast is that this would double over the coming few years. What, in your view, Nilesh, is the structural factors that has driven this growth of affluence in India?
There are multiple factors, Vinay, by which has pulled this. One is the rising tide of India itself. In the 1990, we were $300 billion economy. Today, we are 4 trillion plus. That rising tide has lifted ultra HNI, HNI both. The second one is compliance. When tax rates were high, you wanted to hide your wealth. Now when tax rates are reasonable, you don't mind paying tax and keeping wealth in the normal economy. Third, to some extent, is the retention of talent. Before 90s, Indian talent was always looking to go out. They created wealth worldwide. So many billionaires, so many Fortune 500 companies, CEOs are Indian. Post-1990 liberalization, talent started staying back in India. And there is acceleration post-2014. This talent itself is becoming rich, and they are creating more rich people. So I will say combination of rising tide, compliance, and retention of talent is creating HNIs, and it should continue going forward.
Thank you, Nilesh. Saurabh, if you wanted to add with some data points.
Yeah, I think some very relevant points shared by Nilesh. Couple of data points, whether we talk about ultra HNI, let's say number of individuals with greater than $10 million of net worth, India ranks 4th in the world today with almost 86,000 individuals. If you look at the data on number of dollar millionaires and the pace of growth in that as far as India is concerned, India ranks among the fastest in the world in the top 3, top 4. And that again is expected to grow rapidly over the next few years. A lot of that is getting created by the strong GDP growth, which Nilesh Bhai alluded to. The other thing I would assign as a structural factor is the expansion in capital markets. So what we've seen in India as a country over the last several years, if you were to go back the last few years, is whether it in terms of the promoter equity dilution, which is almost INR 3 trillion in the last 4-5 years. You see almost 1,400, 1,500 IPOs that have also been wealth creation events for startup founders and early employees of those companies. Almost $150 billion getting raised there. Similarly, if you were to see 300 startups have become unicorn in the last 3 years. So a confluence of all these factors and the rising confidence and the GDP growth in India supported by the talent and the formalization of the economy continues to be very, very strong reasons why we've seen rising growth in affluence, and we'll continue to see that over the next few years to come.
A very interesting point you brought, Saurabh, and that's my next question to you, Nilesh, is we have seen a very strong shift from physical assets to financial assets, as Saurabh mentioned, this entire financialization. What has driven this change in asset composition, especially in the affluent segment of clients?
So one, Vinay, managing physical asset is not that easy. If you have real estate scattered all over the country, to put it on rent, to pay the maintenance, to keep it out of the legal issues involved in renting and so on and so forth. By now, people have realized that it's far better to invest in financial assets than real assets and reduce your pain. The second is again compliance. Earlier, real estate or gold was a way to deploy your cash. Now you are generating less cash, might as well go and invest in financial assets. And finally, it is, as Saurabh mentioned, financialization of savings. We have seen many more products coming out of financial industry to compete with the real world. Today, instead of real estate, you can own REIT InvIT. Today, within equity, you have multiple choices available. So combination of factors have come together from compliance, pain of managing real assets, financialization of savings and innovation in finance industry to cater to the needs of customers.
Thank you, Nilesh. Saurabh, if I might come to you and then I'll also take your points, Nilesh, is one clear trend also in this rising affluence has been the growth of equity culture. We have seen a rising equity penetration. This could be through direct stocks, mutual funds, even through AIFs and PMS. Do you see this trend likely to continue and accelerate in the coming few years?
Yeah, absolutely. So just to give, I think Nilesh mentioned several great points. Just to add to them in the context of this question, if you see the kind of household savings pool that we have every year we generate has been growing very strongly at about 8% every year. Within that, the financial component of that is currently about 45%, up from about 40% a few years back. If you were to look at the formal means of investing in financial assets, all capital market products, that itself has grown from about 5% to about 10% of the total, the household savings that are getting generated. Increasingly, because of stronger regulation, very well, and newer products that are getting developed, I think there is a growing knowledge levels as well as awareness as well of investors that are coming in. And I think a lot of good work done, including by SEBI and by AMFI and various other financial institutions. I think that awareness is also leading to development of new asset classes and products that hitherto were not available, and people had to move to physical assets over financial assets. So I think he gave examples of REIT and InvIT. Even on the gold side, I think we've had some great products, and clients can now take access to a lot of this through financial assets, and you don't have to necessarily. And the other beauty of financial assets is that, unlike, let's say, for example, when you buy real estate or any other investment, you have to put a much lumpier investment to buy the same asset. Whereas for a REIT or an InvIT or gold ETFs or through sovereign gold bonds or various other avenues that exist, you could do it at a fraction of that same cost.
Yeah. Liquidity is also much more.
Yes.
So Nilesh, coming to you on equity culture, do you see those trends sustaining? Because we've had also a very strong bull market in India. Do you see that continuing over this decade at least?
So will there be hiccups in this journey? Answer is undoubtedly yes. Will every year be where investors are putting so much money in equity? Yes, there will be ups and downs. Will all the IPOs be successful and in such quantity? Probably there will be ups and downs. But overall, equity is your best way to partner with the best talent of India. If I walk into Bombay House saying that I want to be partnering with Tatas, they will throw me out. But when I buy one Tata company shares, I become legitimate partner of theirs. There's no other instrument in the world where you can make Tata, Birla, Ambani, Adani, Jindal kind of entrepreneurs your partner except stock market. So equity culture will continue to grow. There's no doubt about it, but it will have its own cycle.
Thank you, Nilesh and Saurabh. Before we go into solutioning and servicing for this Ultra HNI segment, I wanted to play a quick game. We call it back it, park it and drop it. So I'll give you three options. Either you back it, you park it or you drop it. So Nilesh, I'll start with you. The first question is around investment themes, diversified equity mutual funds, passive index funds or thematic and sectoral funds.
Thematic and sectoral, drop it. Passive, park it. And diversified fund, back it.
So Saurabh, the second one for you, around investor behavior, home country bias, DIY investing, investing based on market insights.
So international diversification, which is the reverse of home country bias, back that. Investing based on insight, park that. And DIY investing, drop that.
Thank you, Saurabh. Nilesh, coming to you on market trends. Gold as an inflation hedge, AAA rated corporate bonds, or global equity diversification in Indian portfolios?
So gold as an inflation hedge, back it. AAA rated corporate bond, drop it. And global equity diversification through India portfolio, park it.
Thank you, Nilesh. Finally, Saurabh, global versus Indian, the theme. Investing in US equities, going overweight Indian financials, or buying sovereign gold bonds?
So going overweight on Indian financials, back it, park US investing and drop sovereign gold bonds.
Thank you, Saurabh. Thank you, Nilesh, for being a sport. Dear viewers, in this episode, we laid the landscape of rising affluence in India with the need for financialization and greater equity penetration. Join us for the second episode, where we continue our conversation with Nilesh Shah and Saurabh, and we discuss about how to move up the affluent chain and the need for greater sophistication, personalization, and customization on investment solutions for UHNI and HNI segments. Thank you.